I'm so glad my next guest is here to talk about this, talking about Rob Luna, the Survest CEO, very good on the technology sector. Rob, thank you for joining us. This whole Netflix Roku thing, I can't figure it out. As Kelly was just pointing out, it's a 180 for Reed Hastings if you think about it, but I guess different times call for different measures. But what do you make of it?
Yeah, I don't think it makes a lot of sense, Neil, but I do think to the point of Reed Hastings, look, the idea about Reed Hastings and what he's articulated for Netflix over a longer period of time really hasn't been that Jeff Bezos Amazon effect, meaning he wanted to be priced differently than a traditional media company like Disney, but there hasn't been any additional levers that he's pulled. There hasn't gone that books to the cloud, all those different things that Bezos has done. And so when you look at the valuations of the company, it's still trading at 21, 22 times earnings. And we all know if you look at Disney, making original content is very, very expensive. So I think after this huge decline, a lot of people want to come in here and rush to the stock. But I think right where it's sitting at right now is pretty fairly valued. And I think if it goes out and actually makes that acquisition of Roku, I wouldn't be surprised to see 10 to 15% additional downside in the stock.
Wow. You know, Rob, stepping back and looking at technology stocks in general, I think in the Wall Street Journal today, there's a sort of like a bull and bear argument on how much further this sell-off would have to go, or if it goes any further at all. Where are you on that? Because there's some metric that says, you know, typically when technology stocks sell off, as they did after 2000, the drop can be very, very precipitous, and we're about half that right now. Where are you on this?
Yeah, I mean, it's a really different market than it was in 2000. And let's take a look at some of the underlying stocks. You know, everyone's talked about Cathie Wood and her ARC portfolio, which is essentially that innovation of the next 5 to 10 years, kind of like the technology stocks we saw in 99, 2000. If you look at those stocks, a lot of those have beaten up 50, 60, 70%. Compare that index to the NASDAQ today, to the Dow, it's actually significantly outperforming. So I think it's going to be stock selective. A lot of analysts have been talking about that. Some of the names that have been beaten up, like a DocuSign, now they're talking about maybe, you know, Microsoft, Salesforce being a good acquirer of those. Some of those names are so cheap right now. I think the kind of canary in the coal mine is going to be when you do see these companies coming in and making some acquisitions at these levels, 20, 30, 40% above current valuations, that's going to be the all clear to investors to step in. You're already seeing some insiders buying their own stock. But I think right now, let's remember, Neil, we're in a down market. We're in a bear market. We still can't push above that 50-day moving average. And until that ends, I think there's still going to be more continued pressure on the downside.
And that would continue to the big names, the Amazons, the Apples. I think you touched on Microsoft.
Absolutely.
So you don't want to catch potentially a falling knife.
Right, exactly. When those names have actually held up pretty well, Neil. I mean, those are part of the larger indexes. They've done well.
You're right. You're right.
Yeah. That's the big challenge is those big names and the technology and the blue chip names in the Dow still haven't got hit, and the S&P isn't cheap. So I think right now be a little bit patient, sit on the sidelines, maybe start to nibble at some of those names you like longer term down 50 to 60%, but don't try to be a hero in a bear market. It's a very, very dangerous thing to do.
Well worth noting. Rob Luna, thank you very much, Rob. Great catching up with you on this.